Have you ever asked yourself, how does a company like Facebook or Tesla suddenly show up on the stock market? It doesn't just appear out of nowhere. There's a process behind it, one filled with paperwork, high-stakes decisions, and often millions or even billions of dollars. That process is called an IPO, or initial public offering. But here's the real question. Should you care? If you're even thinking about investing, then yes, because understanding IPOs can help you spot opportunities, avoid hype-driven losses, and know what's really happening when the next hot company hits Wall Street. This video, we're going deep. You'll learn not just what an IPO is, but how it works, why companies go public, it's how shares are priced, and how you can make smarter investment decisions. Let's start simple.
IPO.
IPO stands for Initial Public Offering. It's the first time a private company sells shares of its business to the public. Up until this point, the company has been owned by founders, employees, and a few private investors like venture capitalists. But once they decide to go public, they list their shares on a stock exchange, like the NYSE or NASDAQ, allowing regular investors, like you and me, to buy in. It's a massive turning point in the life of a business. It means they've grown big enough, it's ambitious enough, and confident enough to open their doors to the world of public trading. But why would a company want to go public? It's not just for fame. Going public has serious benefits, the biggest being money, a lot of money. By selling shares, a company can raise millions or even billions of dollars to invest in new projects, pay off debt, expand internationally, or build new technologies. It also gives early investors a chance to cash out, turning paper wealth into real money. But there are trade-offs. Public companies are under constant pressure to report earnings every quarter. They face strict government regulation. They lose a level of privacy. Now, everything from executive pay to business risks must be disclosed. So how does a company go public? It starts by hiring investment banks, firms like Morgan Stanley or Goldman Sachs, to guide them through the IPO process. These banks help with paperwork, pricing, and something called underwriting, where they essentially guarantee a certain amount of money will be raised. Then comes the S-1 filing, a long document submitted to the SEC that details the company's financials, risks, and strategy. After that, the company goes on a roadshow, pitching their business to large investors, mutual funds, hedge funds, trying to build interest and hype. Once there's enough interest, a final share price is set, and on IPO day, the stock is officially listed. From that moment, the company becomes public, and the stock begins trading on the open market. Let's look at some real examples. When Facebook went public in 2012, it was one of the most hyped IPOs of all time. It raised $16 billion. But within weeks, the stock dropped sharply. Why? Investors realized Facebook's mobile strategy wasn't clear yet. Fast forward a year, the company adapted, and now it's a tech giant. On the flip side, take WeWork. It tried to go public in 2019, but its business model and leadership came under scrutiny during the IPO filing. The deal collapsed, and the company was forced to delay and restructure. These examples show IPOs are not guarantees. They read just the beginning of a very public journey. Now, here's the big question. Should you invest in an IPO? It depends. IPOs can offer big rewards if you pick the right company early, but they're also risky. Many times, the hype drives the price up on day one, only to crash a few weeks later when the excitement fades. Most retail investors that you and me can even buy shares at the original IPO price. By the time it hits the market, prices are already inflated. If you want to invest in IPOs, do your research. Read the S-1 filing, understand the company's business, and ask yourself, do I believe in their long-term success? Don't invest based on headlines. Invest based on homework. So here's your challenge. The next time you hear about an IPO, whether it's a new tech unicorn or a hyped-up meme stock, just react, pause, research, ask the tough questions, and decide whether it fits your investing goals. IPOs can open the door to wealth, but only if you understand the rules of the game. If this video helped clear up the IPO mystery, hit that like button and subscribe for more beginner-friendly investing content. And drop a comment. Which IPO would you invest in if you had the chance?